Let's get started. We all ready to go?
Yeah, I'd say so, brother. We'll follow your lead here.
Okay. So basically, we're just gonna be doing a futures 101. It's nothing crazy. It's just a quick introduction of what futures is, how it works, how you can make money off futures. I know there's a lot of questions around futures, and it seems kind of like scammy and sketchy, I guess, with prop firms and all. So I'm just here to clear everyone's doubts and kind of just give you a quick run through of what futures is. There you go, and the mouse pops up too. Nice. Okay, so
Now, I
futures.
before you go on here, I've been particularly interested in futures because, we're expanding our product catalog, our offerings, our education. So, I have quite a number of friends who are traders that absolutely swear by prop firms, right? So,
Yeah,
kind of six in one, half dozen the other. I think what it really comes down to is being a disciplined trader. So,
correct,
as you
correct.
were.
And we're gonna get into that same exact thing that you just said in a couple moments, and you're gonna see discipline is the big factor in this. But what is futures? So futures is essentially a contract where you purchase the future price of a commodity or an index fund or a financial instrument. In this case, it's going to be we're talking about NQ and ES, which is the Nasdaq 100 and the S&P 500. And what I like about it is that you can view the I guess the pairing of it on stocks or options as NQ relates exactly to QQQ on the chart. They move the same. They're essentially the same thing. And the S&P 500 or ES is essentially SPY on stocks or options. So whenever I'm viewing like NQ, I could take an options play at the same time that I take a futures play because the chart is the same thing. It's the same movement, right? Now, this is what my chart looks like. I know you're probably looking at it and thinking, what is an FVG? What are all these lines? Um, this is more detail that we'll go into another time, but just a quick run through of it. This is something that you're going to learn today, what an FEG is and how to use it. These lines just mean the time that I like to trade in. I like to trade in very specific times where there's more volume and more movement, better moves, which is the New York session for AM and PM. For me, it's 10 a.m. to 11, then 2 p.m. to 3 p.m., and then there's also a London session from 3 a.m. to 4 a.m. And then this is how I take my trades. Over here, you can see I have a sell and a buy button, market orders, stop limit orders. And here's the amount of units, which are the amount of contracts I take. And in futures, there's two types of contracts. There's a micro and there's a mini. In micros, you're risking $500 per contract. I'm sorry, in minis, you're risking $500 per contract. In micros, you're risking $50 per contract. So essentially, if you're trading one unit of 500, you're like 1 to 1 of it would be making $500, right? That's making 100%. That's how you can kind of view it in percentage wise. I don't like to see it in percentages. I like to see it in either ticks or dollar amount. And here it's great because you can also take profits here, stop loss here, and yeah, that's pretty much how I take my trades here. This is the trading view. It's different than using on any broker's I guess application because here you can trade directly on the chart.
Quick question before you move on there.
Yeah,
So you can connect the prop firm that you trade on, right, which is my funded futures, directly to TradingView. So you're actually trading from your TradingView application. Is that correct?
correct. Yeah, most prop firms, if not all prop firms, allow you to connect I mean, their broker, I guess, prop firm, to TradingView, where you have direct access to the chart and trading on the chart, which makes it less of a hassle. You don't have to switch between apps or anything. You can just trade directly from your chart.
Does anybody have any questions on that before we move on? You can just raise your hand and we'll bring you on stage. All right, everybody seems good on that. Go ahead.
Okay, perfect. And if not, I have a at the end of the session, we have a time for questions, and if you guys want to save them for then feel free to. If not, then you can raise your hand and we'll answer them during the session. But yeah, so this is why I like futures. Futures is, like I said, it's similar to options. You have the ability to day trade and make solid gains, and you're not investing hundreds of thousands or even millions to see any real return, right? And what I like even more about it is that it's different because it's real time price. For example, when you're trading options, you have a contract, and I know you guys are familiar with options. You have a contract, and let me go back to the chart real quick to show you an example. Let's say that we are in this trade and we entered here for puts, right? We probably entered for puts and it came down and went up, it came down and went up, and then at this point, you're like, it looks like you're in the green, but in options, you're either flat or down like 2%. In futures, you get the real price of the index fund that you're trading. So in this case, if I was taking QQQ puts, and I was doing also futures for shorts, I would be seeing a real return at this point where my mouse is at this point. But on options, you would see no real return because there's theta decay, meaning that your options are depreciating as the time moves further to the expiration. Futures doesn't have this. It is a real time price. And you're probably thinking, oh, like Forex is kind of the same, right? And it's even better than Forex because there's literally almost no spreads. It's 0.25 to 1 points. It depends on the time that you're trading, like the session, like Asia, New York, or London. But where everyone should be trading normally, New York, there's really no spread. It'll be the most I've seen during New York is maybe 0.75, which is like if you're trading a mini, it would be $15 difference, which is not bad. Now, prop firms. This is we're gonna get into prop firms and what they do and how they make money and why prop firms are so skeptical, right? So prop firms, they make you prove yourself to be a successful trader, and then you're able to gain access to tens of thousands of dollars in margin for you to profit off, right? Now, what is a prop firm's target? How do they make money? Why are they able to pay out people? It doesn't make sense, right? You buy an account for a little bit of money, you have a lot of margin available, and you're allowed to get paid out. Well, I forgot a zero here. But what is the prop firm's target? Like their ideal target customer? They're thinking, oh, this is quick and easy money. Let's spend $80 and let's make 100,000 plus. Gambler traders, people that think, let me go all in, let me make the most out of it. Like it's only $80 and I'm getting 50,000. No way, this can't be real, right? That's their target customer, and this is where you'll see the ideal profile for their target customers and the people who actually make money off them. So the people that they are trying to target and make the most money off are gamblers. They're impatient, they're greedy, they're fearful, they're undisciplined, and they're lazy. They think everything's going to come fast and quick, and it's going to be $1,000 quick and easy. That's not the reality of it, and that's how a lot of gurus will try to sell it to you on Instagram or any social media. That's not the reality of it. It takes a lot of time. Then the trader two, which is what they don't want to target, is those who are entrepreneurs. They're patient. They're indifferent to viewing money in a quick time frame, I guess. They're confident. They're disciplined, and they're determined. Right. So if you're seeing yourself more in this category, we'll be having more disciplined sessions. I know we had one before, and it's been working. For example, a shout out to HPNO in here. He's seen a big difference. He's doing amazing. He was kind of on the gambler side before, and a little undisciplined. Now he's moving towards being disciplined and patient, and he's seeing real results. So good stuff, HPNO. So here's what it means for the traders that are in the prop firm. So trader one, we have an example. They think, oh, I have 50K. I only paid $80 for it. I'm gonna go all in, so I can make 2,000. This shit's gonna be so easy, right? Wrong. That's not it. If you're doing this, if you're thinking this, prop firm is not for you, and it's not like this. And I know a lot of people like make it seem like this. They paint it like this. It's not like this. Trader 2, and I know HBNO can tell you guys, he can tell you guys all about it. Trader 2 thinks, oh, I have 50K, I paid $80 for it. I'm going to stack up $100 to $200 slowly until I can take out 1,000 so I can invest in a second account, right? Because you see this, and if you're thinking like this, you're thinking of it as a gamble. If you're thinking like this, you're thinking of making it a sort of income. Because think about it, if you can make $100 to $200 in a day, that's more than you're making in a regular day job. Why don't you treat it like a day job and make it a possibility for you to be your day job, day trading, and you take it seriously and you don't take it like a game, right? So yeah, that's trader one, what you shouldn't be doing. Trader two, what you should be doing. And now we're gonna go to the steps into becoming funded, right? So you get a prop firm account of either the following amounts: 50K, 100K, or 150K, and I think there's even 200 to 250K. But you don't need to go that deep into it yet. I suggest either a 50K or a 150K. But we'll talk about that later. And then after you buy the account, you have to pass a challenge. There's a profit target that you have to achieve without losing the limited drawdown, meaning you have to make a certain amount without losing a certain amount. It's strict, but if you're disciplined enough, you're able to take this into account and slowly build up profits and not get too greedy. Like I said, this is where greed and discipline takes a huge part in trading. Because if you're way too greedy, you might lose your gains that you made that day. If you're not disciplined, then you might over leverage, over risk, and not make the profits you were aiming for. So it's always a good idea to have a set trading plan and a goal for each day, or even a goal for each week, because you don't want to trade every single day. Right? Once you pass the challenge, you activate a funded account and trade with real margin. This is the step where you now have access to make real money. Right? After you pass the challenge, then you have to make a set amount of profits and ask for a payout. I know there's two prop firms that I trade with, My Funded Futures and Top Step. My Funded Futures, I'm pretty sure you can take out after 5 winning days, however much you want. But the ideal amount to take out is 1,200 or 2,300. Those are the two like set amounts that it's like the best to take out at. If not, then you can really take out whenever you want. But if you take out less than that, then it drops your drawdown even lower than it should be. And Top Step, you can take out 50% of whatever you make after you make 5 winning days as well. Here's how it works. The evaluation account, it costs, this is on Top Step, by the way. I mean, sorry, My Funded Futures. There's an evaluation account. It costs $80. You get 50K in margin. Your target profit is 3,000. Your max daily drawdown is 1,200, and your max drawdown total is 2,500. Right? Once you pass a $3,000 target profit, you get to a real funded account. Then you have 100% profits for your first 10K, and after the 10K, it goes to 90% you, 10% the firm. And you have the same margin, you have zero target profit, you just have to have 5 winning days of 200 or more. Then you have a max daily loss of 1,200 and the same max drawdown of 2,500. And then here's the trusted prop firms. There's My Funded Futures, Top Step, and Apex. I personally recommend these two, and the difference between the two is that My Funded Futures has no activation fee. So once you pass a challenge, you don't have to pay anything else. Top Step, if you pass a challenge, you have to pay 150 to activate the account. And then Apex is the cheaper one, but there's a lot of I guess not speculation, but a lot of annoying issues with Apex. Like if you make a certain amount of money, they normally ask you to send a video of you trading so they can prove it's actually you. So that's kind of tedious in my opinion. I don't like Apex. It's trusted, but I don't like Apex. I prefer these two, and I am affiliated with My Funded Futures, so we do get a discount in the Discord. Forever, whoever wants a discount and wants to get a prop firm account, My Funded Futures, I have discounts for, so feel free to ask. And then here, we're going to show you guys a confluence. So in trading, I use ICT concepts, and one of these concepts is called a fair value gap. And I'm showing you this now because we're going to be back testing one of the days of this week, and I can show you guys how the movement of the money really is on futures, how fast it is, how much you can gain, how much you can lose, and how a setup typically goes, right? So here's a fair value gap. It's is something that happens between three candles. It's a three candlestick pattern. So you have candle one, candle two, candle three. Why is it called a fair value gap? Because there is a gap between three candles where wick one and wick three do not intersect. So you see there's a wick right here, there's a space, and there's a space here because this wick does not come down and this one does not come up. Wherever there's a space that they don't touch and there's a candle in the middle of it, that is a fair value gap because there is fair value in between this gap, meaning that there was a lot of orders that were taken here, like a lot of buy orders that just shot up. There was like no discussion between buyer or selling. It just went up. It never went to sells. All the sell orders got bought right up, and then we continued going higher. So what does this mean? It means that the market has an imbalance in these areas, and it's more respected on higher time frames like the 5 minute. But if you have a fair value gap and you come down to the fair value gap, let's say there's red candles coming down, more likely than not, it has to go with if it's a bullish trend. Let's say we're in a bullish trend and it comes down, more likely than not, it'll bounce up from this level because there's fair value here, and people want to get the best value for their orders, right? So they'll come down here where there's an imbalance, they'll grab the orders here because there's liquidity here, and then they'll move up and it'll continue up. That's what a fair value gap does. And then there's the opposite, which is an inverse fair value gap. It means you take the first example I showed you, and then you have a candle or two candles or whatever it is comes down and has to invalidate this, right? Once you invalidate this by closing underneath the fair value gap, it is an inverse fair value gap, meaning more than likely, and you have to think about it as well as how your trend is, right? Like let's say we were in a bull trend and then we came down, came up for a little bit, and now we're coming back down, forming lower highs. And then you invert this fair value gap, close underneath it. More than likely, we're going to see a reversal and continue down, right? Now, backtesting time. And before backtesting, actually, I want to see if you guys have any questions first.
Yes, we do have a couple of questions here.
Okay, here we go. Raj, first question, Raj. What's the difference between ticks and pips? So, yeah, pips, like HPNO, pips is more of a forex term, but it's the same thing as ticks. For example, a pip is, or a pip and a tick is for NQ, it's like a 25-cent move. So it's like one single movement in the market is one tick. 1 point equals four ticks or four pips. It's the same thing, but yeah, like HBNO, pip is a forex term. I like to call it ticks, but you can call it however you want.
Smallest amount of volume it takes to move a candle.
Yep, correct. Stupid question. What percent does my contract close with the prop firm? For instance, I see an upcoming move and my timing is a bit off. Can I wait with a prop firm? Is contract automatically closed at a certain percent down? So there's a drawdown, right, on the account, and you can also place your own stop loss. But if you're trading with no stop loss, which I highly do not recommend, if you're trading with no stop loss, you have a daily down draw, and it's not a percentage term. Like let's say you have a 50K account, and your daily down draw, like I said, is 1,200. That's how much you can lose in that day, and how much you can lose in total is 2,500. So it doesn't kick you out at a certain percentage. It just kicks you out at a certain amount of loss before you blow the account. So you can essentially lose your your daily down draw in 1 day and then continue to trade again the next day. But that is not what we're encouraging here. You want to manage risk accordingly. This recorded? Yes, it is recorded. Okay, so it depends on the account size. Yeah. Yeah, like HVNO. All right, great. Thank you, HVNO. That means you can lose per day on the account is 1K before it locks you out. On the account, 2K the max. Blows you the account's actual numbers. You start at 50, 49, 48. Yep. Just like HPNO said. Okay, is there any more questions, guys, before we move on to backtesting? Nope.
Hey, it said thank you. Go ahead.
Okay. All right, perfect. So let's get to backtesting. So we are, hold on 1 second. Let me get a fresh chart. And let's go to NQ. So I'm going to show you guys is one of my strategies that I like to do. It's utilizing the 5 minute during macro and micro times, right? So let's go to a day where this happens. Okay, so here we're going to start with
Could you
Friday.
explain a little bit about what it is you're setting up here on the chart, just for
Yeah,
a little more clarification?
yeah, of course. So I'm writing, like, well, not writing. I'm setting up the times where I like to trade, which is macro. Look, so macro times are New York AM, which is 10 to 11 a.m. Eastern. New York PM, which is 2 to 3 p.m. Eastern. And then there is London macro, which is 3 to 4 a.m. Eastern. These are the time windows that I see the most volume happening and where this specific strategy that I'm going to show you works the best. Some people like to call it silver bullet. It's kind of like weird for the name of it because a lot of people call it a lot of different things. I'm just going to show you it as the macro inversion. That's what I can call it, I guess. Essentially, it is called silver bullet. There's just some different things. So let's go to a replay here, and I'm going to show you. So what I like to do is I start on the 5 minute time frame, right? We are here viewing NASDAQ NQ, or as you guys like to call it on on options, QQQ. And we're doing a replay feature, which shows exactly how buying and selling using a mini contract is, which is the larger contract, the $500 contract. So what I like to wait for in this time frame from New York PM macro 2 p.m. to 3 p.m. is I like to see what I showed you guys right here. I like to see a fair value gap formed and then a fair value gap get inverted and an inverse fair value gap created. This is a strong confluence for reversal, like I said before. So, and most times it does happen in those macro times. So what I like to do is I like to wait for that. And if I don't see that in the macros, I do not take the trade. It saved me a lot from losses and it limits my trading to less. It helps me be more disciplined because I'm only trading in two certain time windows. And I can't let greed get to me because if I'm done trading in this session, in this small time zone of 1 hour each macro, then I don't really look for any other trades. Or at least I try not to. So let's hit the replay and let's see if we're able to find an inverse fair value gap. Okay, and I want you guys to tell me here, is there a fair value gap that formed here or not? You guys can type in the chat or raise your hand, whatever you guys want. Yes. Okay. Now, do you understand why there's a fair value gap there? Like why do you say yes? What's the reasoning? Wicks didn't touch? Perfect. Perfect. Correct. Got 3 candles top and bottom. I mean, yeah, perfect. Got 3 candles. Yep. Yes, the wicks. Perfect. All right, good. You guys are retaining this information pretty quickly. So how I like to draw it, and there's an easier way to draw it, but I'm gonna show you how I do it. I use this magnet tool, which allows me to get the exact wick point. You see, it automatically goes to it. I don't have to go on it. I just hover over it, and boom, it goes right there to the wick. And I use the rectangle tool. I use it right there. I click and I drag it out. So right here we have a bullish fair value gap. I know my candles are different than you guys' colors, but I just changed them. Blue is bullish, white is bearish, right? So here we have a bullish fair value gap. Now, if I have a candle that comes down to this level, what does it mean? What should happen if we come here and in a bull trend? You guys can answer in the chat or voice. Bounce up. Well, King Kojo, an inverse fair value gap is if we close underneath. If we have a candle that closes underneath that rectangle. So yes, Benny, we should bounce up. Yeah, correct. And sorry, I should have said this before too. There's about fair value gaps. There's higher probabilities and lower probabilities. If you have a candlestick that closes here above the midline. This is why I have the midline. If you have a candlestick that closes above the midline, it's a high probability. For example, this is a bullish fair value gap. It's a high probability that we will bounce up. If the candle closes down here, it's a low probability that we will bounce up, right? That's why you use the midlines. If it was let's say it was a bearish fair value gap, it would be the opposite. Like let's say we're coming up and we're supposed to reverse off here down. If we close down here, it's high probability that we will bounce down. I mean, we'll come back down. And if we were to come up, low probability to come back down if that was a bearish fair value gap. But this is a bullish. So if we close here, high probability to come back up. Now if we close here, low probability to come back up. And if we close under, what is that? If we close under that, perfect. Yeah, reversal, inverse fair value gap. That's exactly what it is, right? But fair value gaps are better used with other confluences stacked. That's why I like inverse fair value gap. It's a little bit more certain. But I'm glad you guys are actually taking in this information and you guys are understanding it pretty quickly. So yeah, we have a fair value gap. Now we're gonna wait to see if we either tap into it or invert it or what happens. Let's see. And also I want you guys to take this into account. Remember, you can't just take a trade off a fair value gap and think it's gonna work every time because that's not the case. So we see here, like you guys like to call it in options, we have, I guess, essentially a triple top, right? We have a triple top. We have large wicks here, meaning that we are rejecting to keep going higher, right? So what does this tell you guys? It tells you that essentially we are in a spot where buyers don't have enough strength to keep going higher. So we're kind of rejecting off this level, and you should expect some type of movement downward, hopefully, right? Because it's a level where there's, I guess you guys also like can call it on options, a resistance level. We could say that there's a resistance level right here, right? Because we can't break above it, we can't close above it. It's a resistance. Now, that helps me understand where we should keep going. And now, if I see an inverse fair value gap, which is a reversal confluence, that's going to help me a lot more because I'm already seeing we're in a resistance zone. It's a triple top, just signs that we should come back down, right? So let's see what happens. Press play. And by the way, there's also another fair value gap here. It's just I didn't like to take this one because we had another one right below it. So I like to take the last one to confirm, right? So we're waiting. Boom. Okay, this is how the candle closed. We closed right underneath the fair value gap. So we have now converted this into an inverse fair value gap, right? Here, we can take the short right here. As soon as that candle closes, we take the short and we put our stops right at the wick of the candle that created the initial fair value gap. That's where we put our stop loss, meaning if we were to take the trade on trading view and we take a sell order, if it ever comes back here, it'll automatically sell for me at this level if I take that order right there, right? And you can see that right here. We're going to put a stop loss right there, And now we're going to put a take profit, right? Hold on. Oops. Didn't mean to put it yet. Okay. Sorry. 1 second. Okay, so here we have it, and now we're going to look for our target, right? Where are we aiming to get down to? I like to target liquidity, which are essentially larger areas of wicks where we also reject off, right? So we could set a target price being first target price either right here. This gives you a 1.8 ratio as risk to reward, so you're making 1.8 what you're risking. Or we can target down here, which is you're targeting a 2.7 risk to reward, which is really good. Anything above a 1.5 or 2 is really, really good because you're essentially risking to make more than double what you're risking almost, right? So let's say we take a sell order and we put a stop loss right here. Oh, sorry, right here. Oh, I went so high. It should be right here, right? Stop loss right here. We put our take profits to this wick, and you can see real time what we're risking. We're risking to lose 240 to make 780. So we took the sell order. Now let's see what happens. Boom. Stopped out, right? This kicked us out. Now, I want you guys to understand why this happened. Even though we were in the macro, and I didn't take this trade in real time on Friday, you guys could have seen me on live. I said I wasn't going to take it. This is an example, and I'm showing you the loser first because I want you to understand why I didn't take it. Although we were triple top and we were looking like we were going to come back down and we inverted the fair value gap, this is what you guys need to take into account. So we're going to go back to this candle. Do you guys see? Do you guys see this wick? This wick is enormous. What does this mean? This means that we came down and all of a sudden buyers took every single order that was here and swept it up. So why would I want to go short here? Why would I want to go short if I see this influx of buyers at this level? This means that the buyers took the control again. Yeah, Raj, that's why I was saying like some call it silver bullet, some don't. It's confusing. That's why I said don't refer to it as silver bullet because I've seen a lot of informational videos. Some say like that is silver bullet, some say it's not. So like I said, let's not call it that. And okay, HJs, which fair value gap is preferred of two fair value gaps? The bottom candle fair value gap. Yeah, you kind of want to see where the larger fair value gap is. That's what comes into account. If you have a larger fair value gap and you're taking a inversion of the smaller one, that doesn't really make sense because there's more imbalance in the larger one, right? But yeah, do you guys understand why you shouldn't take this trade? I was on Friday. I'm pretty sure Dylan, you were on that live on Friday, right? Like yesterday on the PM.
Yep.
Yeah, I think I was telling you how I was like every single time I say the move's gonna happen, it happens before my time, and then it happened before my time because I wanted to close here before we went down. So we went down, rejected this big area, which if you guys like, I'm pretty sure you guys know this, regardless of futures, options, whatever it is. If you have a big ass wick one way, what does that mean? We're rejecting off that level. We're rejecting to go lower.
Basically formed a big hammer candle there, which a hammer
Yeah,
candle is in psychology indicative that there was buyers ready to place their orders at that price, thus
correct,
pushing it back up in
correct.
a drastic manner.
And on top of that, we can also see that this is why you always have to be aware of what you're trading and where you're trading, right? We can also see we have a 5 minute fair value gap here that's been respected the whole time and nothing's ever closed below it. So if this keeps happening, like what does that mean? That means okay, like we're not going lower. If I see we rejected off this fair value gap, that's the point where we came back up from, I'm not going to take this short. Look how many times it's been respected. Look at that big disrespect of the lower levels, right? We took all those sell orders that were here and bought back up. So I didn't take this on Friday because of that wick and because the fair value gap. But that is what the setup would be on normal conditions. Now, let's go find one day that it does work on normal conditions. I would tell you guys here, but well, actually here, there's a good example of a fair value gap. It's just it's not the inversion that I was telling you guys about. So we'll look for the inversion that I'm trying to show you guys. Let's see. Let's see if there's one on London. I don't trade London because I'm not awake at 3 a.m. It's crazy. But uh, London 3 a.m. Weak inversion. For strong inversions, you guys want it to happen in less candles. You want the inversion to happen in one or the same amount of candles that created the fair value gap. Let's see. 10 a.m. Okay, this is an example where it did happen, but it happened past 11 a.m. And I did take this trade. I profited like 600, even though I stopped out way earlier, right? So, like I said, for a stronger fair value gap, you want it to be kind of like one candle or two candles. That's almost like the same amount of candles that created the fair value gap. So here we have, let's see, 10 a.m. to 11 a.m. And I was waiting here for this move the whole time. This is also another form of the strategy that I'm showing you guys. Like I said, it can be inside or outside of the macro, but normally you want the move to happen during the macro. Sometimes you get a fair value gap, like a large fair value gap, like this one right here, that happens before the macro, and you're looking to invert it the whole time, right? You're thinking, okay, once we get the inversion of the fair value gap, once we get the inversion of the fair value gap, oh my god, I'm tripping. Once once we get the inversion of the fair value gap, we're gonna take the longs, right? And we're gonna target data highs or this liquidity peak. And it went past 11, and this was a little bit outside of my rules, but it is still acceptable if it's a strong fair value gap inversion. So here we have the fair value gap. We invert it right here on this candle. I took the trade right here, and I put my stops. Since this candle was way too big because it was a data candle, it was CPI. I'm pretty sure it was CPI on Thursday, or it might have been FOMC, one or the other. Huge data candle. You can't really put your normal stops. So what happens if you have a candle this large? Either one, don't take the trade, or two, you use a candle on the 2 minute, like this. Wait a second. Use candles on the 2 minute, right? So what I did is I put my stops right at this wick down here. It was a pretty large stop. I put it at the wick before, well, it was the same as the one that created the fair value gap. It's just on the 2 minute. I put it at this wick, and I targeted these data highs, right? And now we go back to the 5 minute to take a trade. So here we are in the trade. We're going to do the replay right here. And since it was such a large range, I kind of waited a little bit for some sort of retracement. I should put a 2 minute for the retracement because there was a fair value gap on the two. Sorry, where is this fair value gap that I was looking for? Okay, here. Small fair value gap that I waited for a retracement. Since it was such a large move, large stops, I wanted to get the best possible fill. What was it on the two? Sorry guys, I'm trying to think where it was. Here, let me get it. So I can view the actual place of it. So this is a different chart than the one that I was using. I should have had this out before. Okay. let's see, Thursday. Where is this? Sorry, guys. NQZ. Here we go. Okay, here we go. So, all right, now I put my stops here, and I entered off. It was let's see, either a 2 or a 1 minute. So you can use the 5 minutes to scout it, right? And if it's too large of a range, you can go to smaller time frames and look for a better entry point. Yeah, okay, here we go. There's a 2 minute fair value gap. Oh, no, sorry, it's a 1 minute fair value gap right here. Sorry, it's confusing for you guys probably right now. Okay, so large 1 minute fair value gap here that I went from looking at my structure on the 5 and I wanted a better price. So I entered once we tapped into this fair value gap that's created from here to here. We tapped into it after we closed on the 5 minute here, came down, retraced, respected the fair value gap. I entered as soon as it closed, and then we go back to the 5 minute to see the play, right? So this play right here, let's say we took the buys, or sorry, the buys are going to be on the 1. We took the buys right once we tap into it. So let's see. We tap into it, and like I said, here, if we close above here, right, and we have a nice wick like this, this means that it's a high probability fair value gap, right? Or high probability reaction off the fair value gap here. So we close here, and as soon as we close there, I decided to take some buys. I said, okay, I'm going to take one buy, which is 1 micro, and then we're going to let it play out. So this is the real-time movement. It's a little bit choppier here, but you're seeing how it moves. I was up, I was down. Right, we have a fair value gap here. Let's see. And you can see how far it goes through. My target price being right there. We hit the target price. That would have been 1,100. It would have been 1,100. This is a little higher than my target price, but it would have been around $1,100. Now, what I did is I trailed my stops, which is when you're in the trade and it's green, and you move your stops a little higher as you're going. It was right here. Yeah, 475. Right here, I had put my stop loss like right here, and then it came down and it took me out, and I was up like 460, I guess, around there. But overall, winning move here. This is one of the other examples, and now I'm going to show you guys a better example, a better example than this one and the previous ones, right? So let's see. So we're going to go to another session that we have. Let's see. Good example. Sorry, this will be the last back testing, and then I'll go to answer everyone's questions right after.
Yeah, let's try and wrap this up in like 15, 20 minutes if everyone's cool with that.
Yeah, it should be less than that,
Everyone's
for
questions
sure.
though, so no worries.
Okay, so here is an example where we have, instead of an inversion, then we have a fair value gap. Here, actually, is a bad example. Hold on. This week has been choppy. Okay, here we go. Great example. So here, we're in the macro. This is a London session, right? 3 a.m. to 4 a.m. We create, this is an ideal situation where you create the inversion inside the macro. So where it's 3 a.m. to 4 a.m., London macro, we create a down movement, right? We create a fair value gap here. We wick down, we're showing resistance at that lower levels. And then this candle inverses this fair value gap. So what is this? This is an inverse fair value gap inside of the macro. What did I do? Or what did I back test? I tested for this exact level right here. As soon as that candle closed, I took an entry and it would be like this. I took an entry. What did I target? I targeted previous liquidity level right here, which is another internal high. And I was targeting a 1.7 risk to reward. So let's say I take a buy here, and let's see, let's put our stop loss at that level, and let's put our take profit at this level. We're risking $460 to make 775, right? So let's see. Wait, what? Why did it just take me out? That's so weird. Sorry guys, the replay mode's kind of weird sometimes. Where is this? This will be the last one, I promise. Okay, right here. Inverse fair value gap on London macro. We're gonna do the replay right here. We take the buy. So our stop loss is here and our take profit's there, right? So we take the buy and see what happens. Boom. Here. There we go. Plays out perfectly off the inverse fair value gap. You make $755 and you only risked 460, right? So this is a perfect example of how the inverse fair value gap during the macro time works. If you see this type of setup during any macro times, if you don't want to try it, make sure to at least back test it if you guys want to keep looking at it or testing out this strategy. This is a great strategy during macro times, an inverse fair value gap on the 5 minute, only on the 5 minute that it appears. Okay, let's see. Was that wick there previously? Not seem to reach profit. So cool. 3 hours of trading a day. Yeah, essentially that's the great part about using macros, that you're only trading during certain time, like specific times, because you know not everyone has a time to trade 24 hours a day or like all times of market open, right? So if you limit your times of trading, first of all, it's going to make you more disciplined as to when you should trade, and helps you, kind of keep off the charts, because if you're on the charts all day, realistically, it's really hard to not take a trade. It's really hard. Like everyone I know, you're probably itching for a trade if you're on the charts all day, and it happens to me. That's why I started to use macros, because first of all, there's better volume during these times, and there's also just it helps me keep myself disciplined, right? Let's see. If you're like me, you place limit orders at these zones, and either go in your favor or they don't. Yeah, HPNO likes to do limit orders. If it works for him, it works for him. I'm not gonna judge it. If it works for him, it works. I do market orders because I like to wait for closes, because a lot of times you can get wicked out, you can get stopped out. So place limit orders, wait for body candle close above or below. Yeah, so for the inverse fair value gap, for it to be an inverse fair value gap, you need the close under or above the fair value gap. If it's bullish or bearish, it needs to close, and it has to. Because if it doesn't close, that's just a wick. It tells you nothing. And if it wicks and it comes up and it doesn't close below it, more than likely you're not getting that reversal and you're respecting the fair value gap very strongly, right? That's how you understand a fair value gap and an inverse fair value gap. You can't, but without confirmation, it'd be considered front running. Yeah, that is front running, which on futures, front running is kind of harder, because if you're trading adequately and you're using stop losses, then you might get stopped out. If you're trading options, it's a little different, because you kind of have like more risk allowed, I guess. Do you use the fair value gap strategy when in consolidation zones too? Well, that's kind of scalping, I guess. If you're trading in a consolidation, you're basically scalping. So you're trading in between that small range. I don't like to trade between small consolidation ranges. That's basically also called accumulation. I would wait for one confluence to increase odds 100%. So I like to use a couple confluences. Like you guys are probably not going to understand it right now, but it's like draws on liquidity, fair value gaps, inverse fair value gaps, break of structure, many other confluences. Are the fair value gaps under the 5 minute time frame still valid? Um, yes, But you have to take it into account the situation of the trade. Like if you're in a bull trend and you're having a slight retracement, because every time you're going up, you have to come and make higher lows, right? If you're in a bull trend, so you make, let me go to the chart. So essentially, you make higher high, higher low, higher high, higher low, higher high, higher low, and so on, right? Essentially, you make that. Now, let's say let's say you come into, what the, hold on, okay. Let's say you go into one of these times that we come down, right? We come back down, we have a retracement. Now, if you see let's say you see a 5 minute fair value gap that was created right here, right? A 5 minute. And you come down and you're expecting to bounce back up. Now, if you zoom in, oh my god, I need to zoom in, but this thing's not letting me. If you zoom in, and let's say there's a 1 minute fair value gap that was created, I don't know, on the way like here, and it's gonna look different on the 5 minute because there's different structure. But maybe on the 1 minute, this thing right here looks like this, right? Maybe it looks like that. And let's say that on the 1 minute, you create a fair value gap right here. If it's something like this, where this is equal to right here, where we are right here, and it's a 5 minute fair value gap, and it looks like, okay, I'm getting a better entry of the 5 minute fair value gap by using a 1 minute, then that is a perfect use of the 1 minute fair value gap. Does the 1 minute work outside of being inside another fair value gap? Yeah, it does work, but you need to stack other confluences on top of it for the 1 minute to be more than valid. Like you want to see a break of structure, or you want to see um, drawn liquidity. So whenever you stack confluences, that's when you would use the 1 minute. But you don't want to use the 1 minute like just on itself, because there's millions of 1 minute candles, millions of fair value gaps on the 1 minute candle. Doesn't mean that they're all going to be respected. Yeah. So yeah, that's pretty much everything, guys. Quick introduction to futures. If you guys have any questions at all, make sure to ask now before we close the session out. Of course, of course. You too, King Kojo. Enjoy the weekend, bro. Yeah, thank you guys. Thank you guys for coming. I appreciate it that you guys are taking the time out of your days to learn this and really dive into it and actually understand what you guys are looking at.
Yeah, you can see we're pretty serious about this stuff. We do it all week long, and then even on Saturdays and Sundays. So we'll
Yeah.
be having more of these education sessions. I'd like to start my own cryptocurrency version of what Kyrie is doing here as well, because we do a lot of things in the automation space. So while these
Yes, sir.
adrenaline junkies trade in real time, there's also us that like to set the parameters ahead of time. So, there's all kinds of ways to go about this. That's why there's so many different styles of trading and different types of traders. So, Kyrie, thank you. We appreciate it, and feel free to ask questions and don't be a stranger. We love
Of
this stuff.
course. Of course. No problem, guys. Yeah, I'm always here for this. I'm happy to do this. I love this shit. It's what I do. I love it. And yeah, it is recorded. I just recorded it.